Why do you see
Tyler.
us setting ourselves up for disappointment? What are you pinpointing there?
Well, I think it harkens back to something Mike just said. It's not that something broke. It's that we were suffering under the facade that something had broken. And so a 4.3% unemployment rate shouldn't have been that surprising. We'd had it the month before. The Fed had always projected that to embed a 2% inflation number, we needed to get to around that. A jobs number of 114,000, again, shouldn't have been that alarming. We saw 0 basis points growth in core over core for May, 10 basis points core over core for June, which compares to 30 and 40 for the months before that, which we naturally should have implied would have led to a low jobs number. And by the way, we had seen 150,000 in October. And the last thing that people were throwing out to say that the world was ending for those few days was an ISM manufacturing number of 46.8. Again, while contractionary, shouldn't have been all that alarming, particularly when you factor in the services number of 51.4. Yet, we had those vociferously calling for emergency rate cuts, which, by the way, if you were doing that 10 days ago, you should probably be still doing that today. Nothing has really changed. And if you thought that was necessary, then why not now? And the reason I worry is because we got a glimpse into how the market would react if we had a real deceleration. And that wasn't it. Is it going to do so mildly? Sure. I think the consumer is stretched. We have data to suggest that. And I don't think that they can embed this inflation without something of a deceleration from here. And we saw how the market's going to react to that when it starts.
So what I think I hear you say is that here were some incipient signs of what a real slowdown might look like. Rising unemployment, slowing consumer spending, and we got a taste of what the market reaction would be like, right?
That's right.
But there has not been action. But since then, as Mike pointed out, a lot of the numbers have been relatively more benign. Consumer retail spending was pretty good. The CPI was okay. Walmart's doing okay, man. People spending money. So a lot of that worry has dissipated, it seems. Greg, are you there?
I agree, and this is why I say, and what we said. Yep. Hello, can you guys hear me?
Yes, we got you.
You guys got me?
Yep.
Okay, and so I agree, Tyler. This is the underpinning of why I moved to neutral about 6 weeks ago. Is we really have a sweet spot right now. You know, GDP growth doubled into the second quarter. It's projected to rise slightly again in the third. We had the best earnings growth we've had since 2021. But that unemployment number, particularly if the Fed elects to leave it there, and I think they will. I'm in the minority. I'm often in the minority. I don't think they'll cut in September. They don't have to. The retail number, like you said, bounced back in a big way to 1% for retail spending. But nothing's broken in this economy right now. And we are reaching a point where we have some price stability. I don't think they'll risk that newfound price stability with a rate cut, particularly when they failed to have price stability for 3 years.
I think you're absolutely right. You are in the minority with respect to whether there be a rate cut in September or not.